There is a question that every serious investor, every thoughtful person who has ever put money into anything, has asked at some point in their life. That question is this: what separates the people who consistently grow their wealth over decades from the people who simply hope for the best and end up disappointed? Is it intelligence? Is it luck? Is it access to information that others do not have? Is it the right connections, the right timing, the right market conditions? William Green, one of the most respected financial journalists of our time, spent more than 25 years asking that exact question to the most brilliant investors on the planet. He did not just interview them once and write a few paragraphs. He sat with them for hours and hours. He traveled to meet them in their homes, their offices, their favorite places. He watched how they thought. He listened to how they spoke about money, about life, about failure, about success. And what he discovered changed the way he understood not just investing, but the whole art of living well. This is not a story about tips and tricks. This is not a guide that will tell you to buy this stock or sell that one. What William Green discovered is something far deeper, far more valuable, and far more rare. He discovered that the greatest investors in the world are not just better at picking stocks. They are better at thinking. They are better at managing their own emotions. They are better at building the inner architecture of a mind that can handle uncertainty without panicking, that can stay calm when the whole world is losing its head, and that can make decisions based on logic and evidence rather than fear and greed. And here is the truly extraordinary part. The wisdom these investors carry is not just useful for making money. It is useful for building a life that is genuinely rich in every sense of the word. So let us begin this journey together. Let us travel through the minds of the greatest investors who have ever lived. Let us understand how they think, how they protect themselves from their own worst instincts, how they build wealth that lasts, and how they manage to stay wise and, remarkably, happy, even in the most turbulent and unpredictable markets the world has ever seen. The first thing you need to understand is that this journey starts with a simple but powerful idea. The world is full of people who are technically smart, people who can calculate complex mathematical formulas in their heads, people who can process enormous amounts of data, people who have degrees from the most prestigious universities in the world. And yet, many of these technically brilliant people are terrible investors. They lose money. They make panicked decisions. They follow the crowd right off the edge of a cliff. And then there are people who, on paper, seem far less impressive. People who did not go to famous universities. People who do not use complicated computer models. People who work from small offices in quiet towns. And yet these people consistently beat the market year after year, decade after decade. What is the difference? The difference, William Green discovered, is not raw intelligence. The difference is the quality of thinking, the discipline of the mind, and the wisdom of the heart. Let us start with one of the most fascinating and brilliant investors William Green ever met. His name is Charlie Munger. If you have ever heard of Warren Buffett, then you already know that Munger is the quiet genius behind the curtain, the intellectual partner who helped shape Buffett into the investor he became. Charlie Munger is a man who has spent his entire life obsessing over one thing: the art of thinking correctly. For Munger, the greatest enemy of good investing is not the market. It is not economic cycles. It is not bad luck. The greatest enemy is the human mind itself, specifically the human mind's tendency to fall into patterns of bad thinking that feel completely logical in the moment, but lead to disastrous outcomes over time. Munger developed what he calls a latticework of mental models. This idea is so important, so fundamental to everything that follows, that it deserves to be understood clearly and completely. A mental model is simply a way of understanding how something works. Every field of human knowledge, whether it is physics, psychology, biology, economics, history, mathematics, or philosophy, offers certain fundamental principles that explain how the world operates. Most people learn only one or two fields deeply: the field they studied in school, the field they work in professionally. Munger argued that this is a catastrophic mistake. He argued that the world is enormously complex, and if you try to understand it through the lens of only one discipline, you will be blind to everything that discipline cannot explain. Think about a doctor who only knows medicine and has no understanding of psychology. That doctor might prescribe the right medication, but completely fail to understand why the patient refuses to take it. Think about an economist who understands markets perfectly, but has no understanding of human psychology. That economist will build beautiful theoretical models that completely fail to predict what happens when fear and greed take over real human beings in real markets. Munger said that you need to collect mental models from many different fields, load them up into your mind, like tools in a toolbox, and then use the right tool for the right situation. When you have 100 different ways of understanding the world, you can approach any problem from multiple angles simultaneously, and your chances of reaching a correct conclusion increase enormously. One of the most important mental models Munger borrowed from the field of psychology is the concept of cognitive biases. The human brain, beautiful and powerful as it is riddled with systematic errors in thinking. These errors are not random. They are predictable. They follow patterns, and they happen to virtually everyone, including smart, educated, experienced people. One of the most dangerous is what psychologists call confirmation bias. This is the tendency to search for, notice, and remember information that confirms what you already believe, while unconsciously ignoring information that contradicts it. For an investor, this can be absolutely deadly. Imagine you have decided to invest in a company. You have done your research. You believe in the business. Now, your brain starts doing something dangerous. It starts focusing on every piece of good news about the company and filtering out the bad news. It starts finding reasons to feel confident and dismissing reasons to feel cautious. Before long, you are not making decisions based on reality. You are making decisions based on a carefully curated picture of reality that your own brain has constructed to make you feel good about a decision you have already made. Munger spent decades building systems to fight against these natural tendencies of the mind. He developed a habit that he calls inverting. When he faces a difficult problem, instead of asking how he can succeed at it, he asks how he could most completely and catastrophically fail at it. He thinks about all the ways a business could collapse, all the ways an investment could go wrong, all the mistakes he could make. Then, he works backward from those failures and builds protections against them. This sounds simple, but it is profoundly counterintuitive. The human brain naturally wants to think about success. It wants to move toward positive outcomes. Munger forced himself to spend equal time, maybe more time, thinking about failure. And by understanding failure so deeply, he became extraordinarily good at avoiding it. Another principle Munger returned to again and again is the importance of patience. Not patience in the casual sense of waiting a few weeks or months before acting. True patience in the sense of being willing to sit completely still for years, even decades, if the right opportunity has not appeared. Munger once compared himself and Buffett to baseball players who have the advantage of never having to swing the bat. In professional baseball, a batter must swing at certain pitches or risk being called out. But in investing, there are no called strikes. You can stand at the plate indefinitely, watching pitch after pitch go by, and you only have to swing when you see a pitch you absolutely love. Most investors swing far too often. They feel compelled to act. They get bored. They feel they should be doing something. They see other people making money on exciting opportunities, and they feel the pull of envy and impatience. Munger and Buffett developed the discipline to simply wait. They waited for the truly exceptional opportunity. And then, when it appeared, they swung with everything they had. This connects to another essential principle that runs through the entire book like a golden thread. That principle is the importance of concentration versus diversification. Most people who give financial advice will tell you to diversify. Spread your money across many different investments so that no single loss can hurt you badly. And for most people, most of the time, this is completely sensible advice. Diversification protects you from catastrophic loss. But the truly great investors William Green met operate on a different principle. They concentrate. They find the few truly exceptional ideas, the rare businesses that they understand deeply and believe in completely, and they put significant amounts of money into those ideas. They do not spread their bets across dozens of mediocre opportunities just to feel safe. They build conviction in a small number of truly great situations and then act boldly. This is not recklessness. This is the opposite of recklessness. It is the product of extraordinary discipline, extraordinary research, and extraordinary patience. When Howard Marks, or Charlie Munger, or Warren Buffett concentrates a significant portion of their portfolio in one idea, it is not because they are gambling. It is because they have done so much work, thought so carefully, and tested their ideas so rigorously against every possible counter-argument that they have arrived at a very high level of genuine conviction. And genuine conviction, built on genuine understanding, is very different from the blind confidence of a gambler. Now, let us move to another giant of the investing world. Howard Marks is the founder of Oaktree Capital Management, one of the most successful investment firms in history. Marks is famous for his memos, documents he writes and sends to clients and friends, in which he explains how he sees the world of investing and economics. These memos have been collected and studied by some of the greatest minds in finance. Warren Buffett himself has said that when he receives a Howard Marks memo in his inbox, it is the first thing he opens and reads. William Green spent significant time with Marks, trying to understand the source of his extraordinary wisdom. What Marks has developed over his career is a deep, almost instinctive understanding of cycles. Markets move in cycles. Economies move in cycles. Investor psychology moves in cycles. What goes up comes down. What is loved eventually falls out of favor. What is hated eventually gets rediscovered and revalued. Marx has a phrase that captures this beautifully. He says, "We cannot know where we are going, but we can know where we are." In other words, it may be impossible to predict exactly when a market will rise or fall. But by carefully studying the current environment, by looking at how investors are behaving, by listening to the language people use when they talk about markets, by observing how much risk people are willing to take and at what prices, you can develop a reasonably accurate sense of whether the current moment is one of excessive optimism or excessive pessimism, whether things are priced for perfection or for disaster. This is what Marx calls knowing where you are in the cycle. And knowing where you are in the cycle does not tell you exactly what to do, but it helps you calibrate how much caution or how much aggression is appropriate. When markets are euphoric, when everyone is confident, when prices are high and people are ignoring risk, Marx becomes more cautious. When markets are in despair, when everyone is frightened, when prices have collapsed and people are selling anything they can get their hands on just to raise cash, Marx becomes bolder. One of the most powerful ideas Marx has contributed to investing is what he calls second-level thinking. First-level thinking is obvious, instinctive, and lazy. A first-level thinker looks at a company with strong earnings and says, "This is a good company. I should buy it." A second-level thinker looks at the same company and asks a different set of questions. Yes, it is a good company, but is it a better company than everyone already thinks it is? Is the reality better than the expectation? If the company is already universally recognized as excellent, then that excellence is already priced into the stock. Everyone has already bought it. The price already reflects how good it is. To make money, you need to be right about something the market is wrong about. You need to find situations where reality is going to turn out better or worse than the consensus expects. This is why great investing is so difficult. It is not enough to be smart. It is not enough to work hard. It is not even enough to be right. You have to be right about things that most other intelligent, hardworking people are wrong about. And most of the time, if your conclusion is very different from the consensus, you are probably the one who is wrong. The skill is in finding those rare situations where you have done the work, you have thought through the problem from every angle, you have checked your reasoning rigorously, and you have arrived at a conclusion that is genuinely better than what most people believe, not because you have inside information, not because you got lucky, but because you have thought more carefully and more independently. This brings us to one of the most important and most underappreciated qualities that every great investor William Green met shared. That quality is intellectual independence, the ability to think for yourself, the ability to form your own view of reality, hold on to it under pressure, and act on it even when almost everyone around you disagrees. This sounds simple. In practice, it is one of the most psychologically difficult things a human being can do. We are social creatures. We are wired to care about what other people think. We are wired to feel anxiety when we hold a minority view, and we are wired to feel relief when we agree with the majority. These are not character flaws. They are features that helped our ancestors survive in small tribal groups where going against the majority could get you expelled or killed. But in markets, this social wiring is a liability. Markets are often most dangerous when everyone agrees that they are safe. Markets are often most promising when everyone agrees that they are dangerous. The investor who can form an independent view, test it rigorously, and then hold it calmly while everyone else is screaming the opposite has a massive structural advantage. Joel Greenblatt is another investor whose ideas William Green explored deeply. Greenblatt is the author of what he calls the magic formula, a system for identifying undervalued businesses with high returns on capital. But behind the seeming simplicity of this formula lies a sophisticated understanding of value investing and market psychology. Greenblatt ran one of the most successful hedge funds in history, generating returns that most professional investors could only dream of. And then he did something remarkable. He shut the fund down. He returned the money to investors. He went off to teach at Columbia University, the same school where Benjamin Graham, the father of value investing, once taught. And he started writing books to explain his ideas to ordinary investors. Why did he do this? Because Greenblatt believes that the principles of sound investing should not be available only to wealthy professionals. He believes that ordinary people, given the right framework, can invest intelligently and build genuine long-term wealth. The core of his message is this: if you buy a good business at a cheap price, you are going to do well over time. The market will eventually recognize the value that you saw when others did not. The key phrase is over time. This is not a strategy for getting rich quickly. This is a strategy for getting rich slowly but reliably. And for Greenblatt, the slowly but reliably approach is not a consolation prize. It is the gold standard. One of the most important things Greenblatt observed in his years of teaching and investing is that most people who try to implement intelligent value investing strategies end up undermining themselves. They buy the cheap, undervalued stocks. Then, the stocks do not immediately go up. Maybe they even go down a little. The investor starts to feel uncomfortable. They look at other people who are buying exciting, glamorous, fast-growing companies and making money quickly, and they start to second-guess themselves. They start to worry that maybe their analysis was wrong. They start to wonder if maybe the market knows something they do not. And eventually, they abandon the strategy. They sell the cheap stocks just before those stocks start to recover and perform beautifully. This is one of the most painful and common patterns in all of investing. The strategy works. The investor does not. Not because they are unintelligent, but because they cannot manage their own emotional responses to short-term discomfort. The lessons from Greenblatt lead us naturally into one of the central themes of the entire book. That theme is the inner game of investing. The outer game of investing, Understanding businesses, analyzing financial statements, estimating intrinsic value, these are learnable skills. They are important skills, but they are not what separates the truly great investors from the merely competent ones. What separates the great ones is the inner game, the management of their own psychology, the ability to feel fear without acting on fear, the ability to feel greed without surrendering to greed, the ability to hold a position with calm conviction when the market is telling them they are wrong and everyone around them is panicking. Let us talk about John Templeton. Sir John Templeton was one of the greatest global investors of the 20th century, a man who grew up in poverty in rural Tennessee during the Great Depression and went on to build one of the most successful mutual fund companies in the world. Templeton was famous for a single principle that he applied with ruthless consistency throughout his career. That principle was to buy at the point of maximum pessimism. Templeton believed, and proved through decades of results, that the best time to buy any investment is when the situation surrounding it is as bad as it can possibly get. Not just bad as it can possibly get. Because at that point, all the bad news is already in the price. Everyone who is going to sell has already sold. The last fearful investor has already dumped their shares. The only direction left for the price to go is up. In practice, this meant that Templeton was constantly looking for situations that other investors were running away from. He bought stocks during the darkest days of World War II, when the entire world seemed to be collapsing. He bought Japanese stocks after World War II, when most Western investors would not go near Japan. He bought stocks in South Korea in the 1990s, when that country was in the grip of a terrible financial crisis. He was always going where other people were most afraid to go, and he was always making money because of it. But here is the deeply important psychological insight behind Templeton's success. He did not simply buy things that had fallen in price. He bought things that had fallen in price because of temporary fear, not because of permanent impairment. There is a crucial difference between a business that is cheap because people are temporarily frightened and a business that is cheap because it is genuinely broken and unlikely to recover. The discipline is in being able to tell the difference. Templeton was extremely good at this distinction. He looked for businesses with strong underlying fundamentals, good management, real products or services that people needed, operating in markets that had temporarily lost confidence, and he was willing to wait, sometimes for years, for the fear to subside and the true value to be recognized. Templeton was also remarkable for something that is rarely discussed in the context of finance. He was a deeply spiritual man. He believed that the pursuit of wisdom was inseparable from the pursuit of wealth. He established the Templeton Prize, awarded annually to a person who has made exceptional contributions to affirming life's spiritual dimension. He gave enormous sums of money to religious and spiritual research, and he believed genuinely, not as a platitude, but as a core operating principle, that humility was the most important quality an investor could have. The moment you started to believe you had figured out the market, the moment you became arrogant in your conviction, that was the moment you became most vulnerable to catastrophic mistakes. This theme of humility runs through the entire book like a quiet but powerful undercurrent. Every single great investor William Green profiled shared this quality. They all had genuine conviction in their ideas. They all acted boldly when they believed they had found an extraordinary opportunity, but they also maintained a constant awareness of their own limitations, their own potential for error, and the fundamental uncertainty of the future. They did not confuse confidence with certainty. They did not mistake conviction for infallibility. Now let us spend some time with Mohnish Pabrai, one of the most fascinating characters in the book. Pabrai is an Indian-American investor who grew up in relative poverty, built a technology company, and then sold it and used the proceeds to launch an investment fund. His approach to investing is unusual, and perhaps a little shocking to those who believe in the myth of the self-made genius who invents everything from scratch. Pabrai's entire investment philosophy is based on what he calls cloning. He shamelessly, openly, and enthusiastically copies the ideas of the greatest investors he can find. He studies Warren Buffett and Charlie Munger obsessively. He reads every word they have ever written. He listens to every interview they have ever given. And then he applies their principles as directly and faithfully as he can to his own portfolio. This might sound like it lacks originality, but Pabrai argues that it is actually the height of intelligence. In any field, he says, the fastest way to get good is to find the people who are the best and figure out exactly what they do. Then, do the same things. Do not waste time trying to reinvent the wheel. Do not spend years developing original ideas when the original ideas of the greatest thinkers are available and proven. Just clone them. Just apply them consistently and patiently. And then, let compounding do its work. Pabrai also developed a system of checklists that he uses to evaluate every potential investment. This idea came partly from the surgeon and writer Atul Gawande, who wrote about how checklists in medicine and aviation help prevent the kinds of catastrophic errors that happen even to brilliant, experienced professionals in moments of stress or distraction. Pabrai applied the same principle to investing. He created a checklist that asks dozens of specific questions about every business he considers buying. Has this type of business failed before in similar circumstances? Are there any regulatory risks I have not considered? Is the management team honest and capable? What could go wrong that I have not thought of? What are my most optimistic assumptions, and what happens if those assumptions are wrong? By going through this checklist methodically before every investment, Pabrai forces himself to slow down his thinking, to engage the more careful, deliberate parts of his brain, and to catch the mistakes that his more impulsive, pattern-recognizing brain might miss. Pabrai is also famous for something that connects deeply to the wisdom theme that runs through this book. He has a genuinely joyful relationship with both money and life. He gives away a significant portion of his wealth through his Dakshana Foundation, which provides free coaching and education to extremely poor but gifted students in India, helping them gain admission to elite engineering institutions and escape poverty permanently. He has said that giving this money away and watching these young people transform their lives has given him more genuine happiness than any investment return ever could. This is not a coincidence. It is a pattern that repeats across virtually every great investor in the book. The people who have built the most extraordinary wealth are often the ones who are most genuinely unattached to money as an end in itself. They use money as a tool, as a means to create freedom, security, opportunity, and the ability to give. But they do not worship it. They are not controlled by it. And perhaps because of that, they are far better at accumulating it. Let us turn now to a very different kind of investor. Tom Gaynor is the co-chief executive officer of Markel Corporation, a specialty insurance company based in Virginia. What makes Markel extraordinary is that it uses the float from its insurance business, the money it holds in reserve, to pay out future claims, to invest in a portfolio of stocks. In this sense, it operates very similarly to Berkshire Hathaway, the company Buffett built. Gaynor has run Markel's investment portfolio for decades, generating exceptional long-term returns through a philosophy that is elegant in its simplicity but extraordinarily difficult to execute in practice. Gaynor looks for 4 qualities in every business he considers buying. He wants a profitable business model with honest and talented management that has good reinvestment opportunities and is available at a fair price. That is it. Those 4 things: profitable business, honest management, good reinvestment opportunities, fair price. This sounds almost embarrassingly simple, and yet, finding businesses that truly satisfy all 4 criteria is far more difficult than it sounds. Many businesses are profitable, but have managers who are dishonest or incompetent. Many businesses have excellent management, but are in industries where there are no good opportunities to reinvest profits at attractive rates of return. Many businesses are profitable and well managed and have good reinvestment opportunities, but are priced so expensively that buying them guarantees mediocre future returns. What Gaynor has learned over decades of looking for businesses that satisfy all four criteria is that they are rare. They are genuinely rare. And because they are rare, when you find one, you should hold on to it. You should not sell it just because the price has risen, or just because something exciting and new appears on the horizon. You should hold it and let it compound. You should trust the business to keep doing what it has been doing. You should give it time. And time, Gaynor has found, is the most powerful force in investing. Time is what turns a good investment into a great one. Time is what allows compounding to do its extraordinary work. Time is what separates investors who build genuine, lasting wealth from those who are constantly trading in and out of ideas and wondering why their results are so mediocre. Connected to Gaynor's approach is the idea of what William Green calls the inevitability of compounding. Compounding is one of the most remarkable phenomena in the entire universe of mathematics. It is the process by which a small amount of money, growing at a consistent rate over a long period of time, becomes an enormous amount of money. The key insight is not the rate of growth, it is the time. Given enough time, even a modest rate of consistent growth produces extraordinary results. And the investor who understands this truly understands it, not just intellectually, but emotionally and practically, will structure their entire investing life around maximizing the time their money has to compound. They will avoid selling. They will avoid churning their portfolio. They will pay as little in taxes and fees as possible, because every dollar that leaves the portfolio in the form of taxes or fees is a dollar that can no longer compound, and they will have the patience to sit still and let the process work. Nick Sleep is perhaps the least well-known investor in the book, but his ideas are among the most powerful. Sleep ran a fund called the Nomad Investment Partnership from London for many years, and during that time, he generated returns that ranked among the very best in the world. Then, like Greenblatt, he shut the fund down when he felt it had become too large to operate at maximum effectiveness, returned the money to investors, and walked away from the business to live quietly and pursue his own interests. Sleep had one central insight that he applied with extreme concentration. He believed that the key to extraordinary investment returns was finding companies with what he called a sharing business model, specifically, companies that were structured in such a way that as they grew and became more efficient, they would pass the benefits of that efficiency on to their customers in the form of lower prices or better service. This sounds counterintuitive at first. Why would you want to invest in a company that keeps lowering its prices? Surely that means the company makes less money over time. But Sleep saw something different. He saw that when a company genuinely and consistently puts its customers first, when it builds its business model around making the customer's life better and cheaper, it creates an extraordinary cycle of loyalty and growth. Customers who are treated exceptionally well come back. They bring their friends. They spend more money over time. They become advocates for the business, and the business grows and grows until it has a position so dominant in its market that it is almost impossible to dislodge. The two companies that Sleep invested in most heavily, the two that generated the vast majority of his extraordinary returns, were Amazon and Costco. Both Amazon and Costco are companies built on the idea of passing efficiency gains on to customers. Amazon has consistently invested its profits back into lower prices, faster delivery, and broader selection. Costco has built its entire business model around offering its members the best possible value, charging them a membership fee, and then selling everything else at near cost. Both companies seem on the surface to be companies with thin margins and intense competition. But Sleep recognized that their customer focus created a compounding advantage. As they grew, they became cheaper and more efficient. As they became cheaper and more efficient, they attracted more customers. As they attracted more customers, they grew even more. This virtuous cycle, powered by genuine customer focus and sustained by consistent reinvestment, made both companies worth enormously more today than anyone could have imagined when Sleep first invested. The lesson from Sleep is not simply to invest in Amazon and Costco. The lesson is to look for the underlying principle. Look for businesses that are genuinely structured to create more and more value for their customers over time. Look for businesses where the incentives of the management are genuinely aligned with the long-term interests of both customers and shareholders. Look for businesses where the business model itself creates a compounding advantage that makes the company harder to compete with as time goes by. These are rare, but when you find them, they reward patience in a way that almost nothing else in the investment universe can match. Now, let us talk about Ed Thorp. Ed Thorp is one of the most remarkable people in the book, a man whose life reads like a novel. He was a mathematics professor who figured out how to beat the blackjack tables in Las Vegas using mathematical principles and pioneered the use of card counting. He wrote a book about his system called Beat the Dealer, and it caused casinos to change their rules. Then, he applied similar mathematical thinking to financial markets and became one of the first people in the world to develop what are now called quantitative investment strategies, using mathematical models to identify mispricings in securities and exploit them systematically. His fund generated extraordinary consistent returns for decades, with a remarkably low number of losing periods. What William Green found most fascinating about Thorp was not his mathematical genius, although that is remarkable, but his relationship with risk. Thorp had an absolutely clear-eyed, unsentimental view of risk and uncertainty. He knew that no matter how well you understood the mathematical probabilities, you could not eliminate uncertainty. You could only manage it intelligently. And managing it intelligently meant never betting so much on any single outcome that a bad result could destroy you. It meant always keeping enough in reserve to survive even the worst-case scenario. It meant building systems that worked across thousands of repetitions, not just in a single lucky moment. Thorp developed a mathematical system called the Kelly criterion, which tells you the mathematically optimal fraction of your capital to bet in any given situation with known probabilities and payoffs. The Kelly criterion maximizes the long-term growth rate of your capital while preventing you from ever going broke through a long sequence of losses. It is an elegant and powerful idea, and its central insight is this: even if you have a genuine edge in a particular investment, betting too large a fraction of your capital on it is dangerous. The mathematics of compounding work in both directions. A large loss requires a proportionally even larger gain just to get back to where you started. So the optimal strategy is never to bet the maximum that your confidence justifies. It is to bet a somewhat smaller fraction, a more conservative fraction, that allows for the inevitable bad runs without destroying your ability to continue playing the game. Thorp's approach to life more broadly is also instructive. He is a man who has always been driven not by the desire for money, but by the desire to solve interesting problems. He got into blackjack not because he needed the money, but because the problem of whether a skilled player could beat the house was mathematically interesting and seemed unsolved. He got into financial markets not because he needed the returns, but because the problem of whether mathematical models could identify systematic mispricings was intellectually fascinating. This orientation toward the problem and the craft, rather than toward the outcome and the reward, is another characteristic that appears again and again among the greatest investors in the book. Jean-Marie Eveillard is a French investor who spent decades running the First Eagle funds from New York with extraordinary success. Eveillard represents a particular strain of investing wisdom that is sometimes called the preservation of capital approach. His central belief, formed over decades of watching markets rise and fall, is that the most important thing in investing is not how much money you make, but how much money you avoid losing. This might sound conservative to the point of timidity. It is anything but. It is actually a profound insight into the mathematics of wealth building. The reason avoiding losses is so critically important comes back to compounding. If you lose 50 cents out of every dollar you have, you need to gain back 100% of what you have left just to get back to where you started. This asymmetry is brutal. A 50% loss requires a 100% gain to recover. A 70% loss requires a gain of more than 230% to recover. These are not just numbers. They represent years and sometimes decades of your investing life spent simply getting back to zero rather than building wealth. Abelard understood this mathematics so deeply that it shaped his entire approach. He would rather earn somewhat less in good times in order to be certain of not suffering a devastating loss in bad times. To achieve this, Abelard was famous for holding gold in his portfolio at times when other investors thought it was irrational. He held large amounts of cash when most investors were fully invested in stocks. He bought cheap insurance against market crashes in the form of options and other derivatives. His colleagues and competitors often criticized him for being too cautious, for leaving money on the table during bull markets. But when markets collapsed, as they inevitably do, Abelard's clients were protected in ways that his critics' clients were not. And over the full length of a career, protection in the bad times is worth far more than any extra gain in the good times. The conversation with Abelard also touches on something that William Green found poignant and deeply human. Abelard talked about a period in the late 1990s, during the great technology stock bubble, when his cautious approach and his refusal to buy the expensive technology stocks that were making everyone else rich led to massive outflows from his funds. Investors were leaving in droves. They wanted to be in the hot technology stocks. They did not want a cautious Frenchman telling them to be careful. Abelard's firm almost fired him. His career was in genuine jeopardy, and yet he held his ground. He refused to abandon his principles just because everyone else was making money by ignoring those principles. And then, when the technology bubble burst and the market collapsed by more than 50%, Abelard's funds barely lost anything. The investors who had abandoned him for the excitement of technology stocks lost fortunes. Abelard's remaining investors were protected. The moral of this story is not just that Abelard was smart and his critics were foolish. The moral is about the courage it requires to maintain conviction when everything around you seems to suggest that you are wrong. The moral is about integrity. The moral is about the willingness to be genuinely unpopular in the short term in order to be genuinely right in the long term. This quality, the willingness to accept unpopularity and ridicule in defense of a well-considered position, is one of the most rare and most valuable qualities an investor can possess. And it requires not just intelligence, but genuine character. Francis Chu is a Canadian investor who was born in India and immigrated to Canada as a young man with almost nothing. He started investing with a small amount of money saved from his salary as a technician at Bell Canada. He formed an investment club with some colleagues, studied Benjamin Graham intensively, and built his approach from the ground up based on the principles of deep value investing. Today, he manages one of the most respected value funds in Canada, and his long-term returns are extraordinary. What William Green found most remarkable about Cho is not his investment record, but his character. Cho is a man of profound simplicity, honesty, and patience. He does not try to be clever. He does not try to find complicated, exotic opportunities. He simply looks for businesses that are selling at very large discounts to what he calculates their true worth to be, and then he waits for the market to recognize that worth. He does not panic when his stocks decline. He does not feel pressure to perform in the short term. He manages a relatively small amount of money, by the standards of large institutional investors, and this allows him the freedom to go wherever the value is, including small, obscure companies that the large funds cannot touch because they are too small to make a meaningful difference to their portfolios. Cho represents something important. He represents the fact that you do not need to be in New York or London or Hong Kong. You do not need to manage billions of dollars. You do not need sophisticated computer systems or enormous teams of analysts. What you need is a sound intellectual framework, the patience to apply it consistently, and the emotional strength to hold your positions when the market is working against you. These are things available to anyone who is willing to develop them. And that democratizing message, the idea that sound investing is fundamentally about ideas and character rather than resources and connections, is one of the most hopeful and empowering messages in the entire book. Will Danoff manages the Fidelity Contra Fund, one of the largest actively managed mutual funds in the world, with hundreds of billions of dollars under management. Managing a fund that large is an almost impossibly difficult task. The sheer size of the portfolio means that small companies, however attractive, cannot meaningfully affect the fund's performance. Every idea has to be large enough to make a real difference to a portfolio of that scale. And yet, despite these enormous constraints, Danoff has consistently delivered excellent results for his investors over a career spanning decades. How does he do it? Danoff is famous for his extraordinary work ethic and his relentless curiosity. He meets with an enormous number of company management teams. He listens. He asks questions. He is trying to identify the companies that are going to be significantly better businesses in 3 to 5 years than they are today. Not just good businesses now, but businesses that are on an upward trajectory of quality and value. And he is willing to pay a fair price for those businesses because he believes that quality businesses that are getting better will eventually justify almost any reasonable price as their earnings grow and their value compounds. Danoff also represents a specific and important point about what William Green calls the investor's edge. Most successful investors build their edge in one of a small number of ways. They develop information advantages by doing more work and meeting more people than their competition. They develop analytical advantages by thinking about businesses in more depth and with more nuance than others. They develop psychological advantages by managing their own emotions better than most people. They develop patience advantages by being willing to hold good businesses for longer than most people can tolerate. Danoff's edge is primarily informational and analytical. He simply knows more about more companies than almost anyone else in the business, because he works extraordinarily hard to know them. The point is not that every investor should copy Danoff's specific approach. The point is that every investor needs to find their own edge. What is the specific, genuine advantage that allows you to do better than the average investor? If you cannot identify it, if you cannot articulate clearly what makes your approach better than just buying an index fund, then perhaps the most honest and intelligent thing to do is to simply buy the index fund. Not as a defeat, but as a rational acknowledgement of reality. An index fund will outperform the vast majority of actively managed funds over long periods of time. Recognizing this is not weakness, it is wisdom. This brings us to a central philosophical question that runs through the book. Is it worth trying to beat the market? The mathematical evidence is humbling. The vast majority of professional fund managers fail to beat their benchmark over long periods of time after fees are subtracted. Most individual investors do even worse. And yet the people profiled in this book have consistently beaten the market for decades. So, it is possible. It is just difficult. It requires genuine skill, genuine discipline, genuine patience, and a genuine edge. If you have those things, or if you are willing to put in the extraordinary work required to develop them, then active investing may be worth the effort. If you do not have those things, or if you are not willing to develop them, then passive index investing is not just acceptable, but actively correct. Now let us turn to what may be the most profound and important section of the entire journey through this book. The question that William Green keeps returning to, the question that ultimately defines the entire work, is not how do you make the most money? It is how do you live well? How do you build a life that is genuinely rich, not just in financial terms, but in every dimension that matters? And what he found is that the greatest investors, the people who have been most successful at accumulating wealth, are also, on the whole, some of the most thoughtful, most reflective, and most genuinely content people he has ever met. Not all of them, not in every case, but the pattern is remarkably strong. Why? Because the qualities that make you a great investor are the same qualities that tend to make you a great human being. Patience, intellectual honesty, the willingness to think independently, the courage to hold a minority view, the humility to acknowledge your own limitations and mistakes, the capacity to delay gratification, the discipline to focus on what matters and ignore what does not, the generosity of spirit that comes from recognizing that money is a tool, not an end. These are not just investment virtues, they are human virtues. They are the qualities that appear in the lives of wise, good, and genuinely happy people across every culture and every era. Charlie Munger, who is well into his 90s by the time William Green writes this book, has thought more deeply about how to live well than perhaps anyone Green has ever met. Munger's approach to his own life is governed by the same mental models he applies to investing. He has spent his life acquiring knowledge across as many domains as possible, not just to make money, but because he believes that understanding the world more completely is simply one of the greatest pleasures and privileges of being alive. He reads voraciously. He thinks carefully. He talks to interesting people. He has built a life of extraordinary richness, not through luxury or entertainment, but through the sheer quality of his thinking and the depth of his engagement with ideas. Munger is also famous for a principle he calls avoiding the standard stupidities. He does not think his success comes primarily from being extraordinarily smart. He thinks it comes from avoiding the kinds of stupid mistakes that most people make because of cognitive biases, emotional reactions, and simple laziness of thinking. He has said that one of the most important qualities of the great investors he most admires is what he calls not being a damn fool, which sounds almost insultingly simple. But what it means in practice is extraordinarily demanding. It means having the discipline to follow your own carefully considered principles even when it is uncomfortable to do so. It means not being swayed by the noise of the market, the opinions of others, or the seductive pull of short-term thinking. It means recognizing your own limitations honestly and structuring your approach to accommodate those limitations rather than pretending they do not exist. One of the most powerful stories in the entire book involves the period after the 2008 financial crisis. The crisis was one of the most severe market collapses in the history of capitalism. Major financial institutions failed. Stock markets around the world fell by enormous amounts. Ordinary people lost their savings. The general sense was that the financial system itself might collapse entirely. And in this environment, several of the investors profiled in the book made some of the best investments of their careers, buying businesses of extraordinary quality at prices that reflected the maximum of fear and the minimum of hope. Howard Marks, in particular, was active during this period in a way that required extraordinary psychological strength. His firm was buying distressed debt, the bonds and loans of companies that were in or near bankruptcy, at prices that reflected the extreme panic in markets. These were not comfortable positions. The phone was ringing constantly, with worried investors demanding to know what was happening to their money. The news was uniformly terrible. Every piece of economic data suggested that things were going to get even worse, and yet Marx continued to buy. He had done the analysis. He knew the prices were extraordinary relative to the underlying value of the assets. He had the conviction and the courage to act on that analysis, while almost everyone around him was paralyzed by fear. The returns from those investments, made in the darkest days of the crisis, were extraordinary. But what William Green wants us to understand is not just the outcome. He wants us to understand the inner experience of holding those positions, the sleepless nights, the constant questioning, the awareness that if you were wrong, the consequences would be severe and public. The ability to act confidently under those conditions is not just a financial skill, it is a form of character, and it is something that can be cultivated, but only through years of practice, reflection, and the kind of deep self-knowledge that allows you to trust your own judgment, even when external conditions are trying their hardest to make you doubt it. Self-knowledge. This is perhaps the most underrated quality in the world of investing. The great investors that William Green met all had a remarkably clear-eyed understanding of their own strengths and weaknesses. They knew what they were good at and what they were not good at. They knew what kinds of situations played to their strengths and what kinds they should avoid. They had built investment strategies that worked with their own psychology rather than against it. This kind of self-knowledge is not automatic. It requires deliberate reflection. It requires the willingness to look honestly at your own mistakes, to understand why you made them, and to build systems that protect you from making the same mistakes again. Mohnish Pabrai, for instance, recognized early in his investing career that he had a strong tendency toward overconfidence. He was good at finding ideas, good at doing the analytical work, but he tended to be too certain of his conclusions. So he built the checklist system not just as an abstract exercise in rigor, but as a specific antidote to his own psychological tendency toward overconfidence. Every time he goes through the checklist, he is essentially having a conversation with his more cautious, more skeptical self, the self that asks the difficult questions and refuses to be satisfied with easy answers. Tom Gaynor knows that he is not particularly good at predicting short-term market movements or economic conditions. So his strategy explicitly does not try to do that. He does not make big macro bets on interest rates or currency movements or the direction of the economy. He focuses entirely on what he is good at, which is identifying excellent businesses and holding them for a very long time. By structuring his strategy around his strengths and away from his weaknesses, he has been able to generate excellent results without exposing himself to the kinds of risks that come from trying to do things you are not genuinely good at. This idea of building your investing approach around your own specific strengths and away from your own specific weaknesses is something that sounds obvious, but is rarely actually done. Most investors try to do everything. They try to predict markets, pick individual stocks, time their buying and selling, manage their emotional reactions, and stay informed about every relevant development in the global economy simultaneously. This is an almost impossibly demanding set of tasks, and trying to do all of them at once almost guarantees that you will do none of them particularly well. The great investors made choices. They concentrated their attention and their energy on the things they were genuinely best at, and they either delegated or avoided the things they were not. Now let us talk about something that runs through the book almost like a spiritual theme: the relationship between money and happiness. This is a question that humanity has been asking for thousands of years, and the evidence from psychology and from the lives of extraordinary people like those in this book points in a consistent direction. Money, up to a certain point, does genuinely improve quality of life. Having enough money to cover your basic needs, to provide security and stability, to have the freedom to make choices about how you spend your time, these things genuinely matter and genuinely increase well-being. But beyond a certain threshold, the relationship between money and happiness breaks down. More money does not produce more happiness in any reliable or proportional way. And chasing money as an end in itself, making the accumulation of wealth the central purpose of your life, is a path that almost universally leads to a kind of emptiness that no amount of money can fill. The investors in this book understood this, either from the beginning or through hard experience. John Templeton gave away enormous amounts of his wealth and said that his charitable activities gave him more meaning and satisfaction than his investment activities ever had. Mohnish Pabrai discovered that the work he was doing through his foundation to change the lives of brilliant but impoverished young people in India was the most genuinely meaningful work of his life. Charlie Munger has said repeatedly that the happiest period of his life was when he was a relatively poor young lawyer, engaged in interesting intellectual work, surrounded by people he loved, with enough to live on, but no great wealth. The great wealth came later, and it was certainly not unpleasant, but it did not, in his assessment, add proportionally to his happiness. This is not a counsel of indifference to money. These are people who have worked extraordinarily hard to build extraordinary wealth. But they worked hard not primarily because they were chasing money, but because they genuinely loved the intellectual challenge of investing. They loved the puzzle. They loved the process of figuring out what was true and what was not. They loved the game. And the money was the natural consequence of playing the game extraordinarily well. But the money was never the point. And because the money was never the point, they were never enslaved to it. They were never trapped by the fear of losing it. They were never distorted into doing things they believed were wrong just to protect or increase it. And this freedom, this internal freedom that comes from not being controlled by the desire for wealth, even while you are actively building it, is one of the deepest insights in the entire book. There is a passage in the conversation with Howard Marks where he talks about what he calls the double-edged quality of success in investing. Every great success in investing creates its own psychological trap. When you have been right many times, when your track record is extraordinary, when people admire and respect your judgment, you start to develop a level of confidence in yourself that can, if you are not careful, shade into overconfidence. The very success that makes you genuinely skilled can start to make you believe you are infallible. And the moment you start to believe you are infallible is the moment you become most vulnerable to a catastrophic mistake. Marx has built into his own thinking and his firm's culture a constant, deliberate counterweight to this tendency. He encourages skepticism even of his own most confident ideas. He creates processes that force his team to challenge him and each other. He tries to maintain, always, the awareness that being right in the past is no guarantee of being right in the future, and that the next idea, however convincing it seems, needs to be tested as rigorously as the first one. The theme of intellectual humility in the face of genuine uncertainty is something that Marx has thought about and written about more deeply than almost anyone in the investment world. He talks about a spectrum that runs from those who believe they can know with certainty what the future holds on one end, to those who acknowledge complete ignorance of the future on the other end. Most people in financial markets sit closer to the first end than they should. They make confident predictions about where the market will be in 6 months, about which companies will perform best over the next year, about the direction of interest rates and currencies and commodity prices. These predictions are almost universally wrong, not because the people making them are stupid, but because the future is genuinely unknowable in the specific, quantitative way that investment decisions require. Marx sits closer to the other end of that spectrum. He has genuine humility about his ability to predict the future, but he has also recognized that this humility does not mean paralysis. It means something more subtle and more powerful. It means building your investment approach in a way that does not depend on being right about specific predictions. It means structuring your portfolio so that it can survive and even thrive in multiple different future scenarios. It means always being aware of the risks you are taking and making sure that even if a bad outcome occurs, you will still be standing, still in the game, still able to invest and compound and recover. This is what Marx means when he talks about the most important thing, which is not any single investment insight, but the overall discipline and risk awareness that allows you to survive in investing long enough for your skills to actually express themselves. Let us now turn to something that might seem counterintuitive, but is actually deeply important: the role of failure in the development of a great investor. Every single person in this book has failed, not just a little. Some of them have failed catastrophically, in ways that wiped out significant portions of their portfolios, damaged their reputations, and caused them genuine personal anguish. And yet, they all recovered. They all learned. And in most cases, they came back stronger, wiser, and more effective than they had been before the failure. Bill Miller is one of the most famous examples in the book. Miller ran the Legg Mason Value Trust Fund and had the extraordinary achievement of beating the market index for 15 consecutive years, one of the longest winning streaks in the history of actively managed investing. He was celebrated as a genius. He was profiled in major publications. He was admired by investors around the world. And then, in 2008, his fund collapsed in a way that was almost as spectacular as its rise. He had made concentrated bets in financial companies, believing they were undervalued, just as the financial crisis made those bets catastrophically wrong. The fund lost an enormous fraction of its value. Miller's reputation was shattered. His career was in ruins. What happened next is what makes Miller's story so instructive. He did not give up. He rebuilt. He went back to first principles. He thought carefully about what had gone wrong and why. He recognized that his confidence in his own judgment had, in fact, shaded into overconfidence. He recognized that he had not paid enough attention to the possibility of a genuinely catastrophic outcome, the kind of tail risk that his previous success had perhaps led him to underestimate. He rebuilt his investment approach with a clearer-eyed acknowledgement of his own vulnerabilities, and he rebuilt his career. He launched a new fund. He generated strong returns again. He demonstrated that genuine skill, properly chastened and refined by the experience of failure, can reassert itself. The message William Green draws from Miller's story is not that failure is always recoverable, though often it is. The message is more subtle. It is that the experience of genuine, painful failure is often the most powerful teacher available to an investor. Success, however gratifying, teaches you mainly that you were right. But failure forces you to examine your assumptions, test your convictions, identify your blind spots, and build new safeguards against the weaknesses it has exposed. The investors who have built the most durable long-term records are often those who suffered painful failures early enough in their careers to learn from them before the stakes became truly catastrophic. This connects to what William Green calls the importance of building your own investment philosophy rather than simply copying someone else's. Every great investor in the book had to go through the difficult process of figuring out what they actually believed, what they were actually good at, and what kind of investing actually suited their specific temperament, knowledge, and circumstances. This process involved reading widely, thinking deeply, learning from others, experimenting with ideas, making mistakes, reflecting on those mistakes, and gradually refining their approach over many years. There are no shortcuts to this process. You cannot simply adopt someone else's philosophy as if it were your own. You have to go through the experience yourself. You have to feel the emotions that different kinds of investing produce in you. You have to discover, through direct experience, which approaches you can actually sustain under pressure and which ones you will abandon at the worst possible moment. The practical implication of this is that every investor needs to be deeply honest with themselves about what they actually want and what they actually believe. If you are the kind of person who cannot sleep when your portfolio is falling and who tends to panic and sell at exactly the wrong moment, then a highly concentrated portfolio of volatile stocks is not the right approach for you, regardless of how good it might look in theory. If you are the kind of person who gets bored easily and needs constant activity to stay engaged, then a buy and hold approach that requires you to do nothing for years at a time is going to be psychologically torturous, and you will probably abandon it. Knowing yourself well enough to match your investment approach to your actual psychological makeup is one of the most important and least discussed aspects of successful investing. Let us now talk about something that William Green explores in the later sections of the book, the question of what it means to be a genuinely good investor in the context of your whole life. Not just good at picking stocks or generating returns, but good in a deeper, more integrated sense. A good investor, who is also a good person, a good parent, a good citizen, a good steward of the time and energy and resources that life has given them. Several of the investors in the book have made choices that might seem strange or even irrational from a purely financial perspective, but make perfect sense from the perspective of a well-lived life. Joel Greenblatt chose to shut down his extraordinary hedge fund and start teaching. Nick Sleep chose to shut down his successful fund and step away from the investment world entirely to pursue other interests. Mohnish Pabrai chose to give away a significant fraction of his wealth to education for the poor. These are not choices that maximize financial return. They are choices that maximize the quality of a whole life. And this, perhaps, is the deepest insight in the entire book. That the skills of the great investor, properly understood and properly applied, are skills for living well in general. The ability to think clearly and independently, the discipline to delay gratification, the humility to acknowledge what you do not know, the patience to wait for the right opportunity, the courage to act boldly when the opportunity arrives, the wisdom to know what truly matters and what does not. These are not just investment skills, they are life skills. They are the qualities of a person who can navigate the enormous complexity and uncertainty of the modern world with grace, wisdom, and genuine equanimity. William Green himself, in the course of writing this book and spending so much time with these extraordinary minds, found that his own life was changed by the process. He did not become a billionaire. He did not discover a secret formula for guaranteed investment success. But he developed a clearer, more disciplined, more principled way of thinking about both money and life. He became more patient. He became more honest with himself about his own limitations. He became more focused on what truly mattered to him and less distracted by the noise of the financial world. And he found that this shift in thinking, this gradual accumulation of hard-won wisdom, made him genuinely richer in the ways that matter most, not necessarily in terms of the balance in his bank account, though hopefully that too, but in terms of the quality of his experience of being alive. One of the most beautiful and moving parts of the entire journey through this book comes from a conversation William Green had with Charlie Munger about the nature of the good life. Munger has spent nearly a century on this planet, has accumulated virtually every form of material success that society has to offer, and has arrived at a set of conclusions that are as clear and as simply stated as anything he has ever said about investing. He believes that the good life is built on a small number of truly important things: good health, both physical and mental; deep and lasting relationships with people you genuinely love and who genuinely love you; work that is genuinely interesting and meaningful to you; enough financial security to live without fear and anxiety about basic necessities; and the continuous cultivation of wisdom through reading, thinking, and learning throughout your entire life. Notice what is not on that list: extreme wealth, fame, status, the admiration of strangers, the accumulation of luxury possessions. These things are conspicuously absent, and Munger's absence of them from his list of what makes a good life is not the result of having never experienced them. He has experienced virtually all of them. It is the result of having thought carefully over a very long life about what actually contributes to genuine human flourishing and what does not. And his conclusion, arrived at through decades of careful observation and reflection, is that the things that genuinely matter are simpler, more fundamental, and more available to ordinary people than the world of finance tends to suggest. This is a message worth sitting with for a long moment. The greatest investor of his generation, a man who has accumulated more wealth than most people can imagine, is telling us that the secrets to the good life are not primarily financial. They are human. They are about the quality of your thinking, the depth of your relationships, the meaning of your work, and the wisdom with which you navigate the choices that life presents. Money is a tool that can support these things, but it cannot replace them. And the pursuit of money at the expense of these things is, In the long run, a terrible bargain. Let us now turn to a practical framework that William Green extracts from all these conversations. A kind of synthesis of the best ideas from all the great minds he has spent so much time with. This framework is not a formula for picking stocks. It is a framework for thinking about investing in a way that is honest, disciplined, humble, and genuinely likely to produce good results over a lifetime. The first element is to be honest about your own limitations. Know what you are good at and what you are not. Know what kinds of investing you can sustain psychologically and what kinds will cause you to make terrible decisions under pressure. If you are not genuinely good at picking individual stocks and holding them with conviction through periods of volatility, do not try to do that. Use index funds. Use diversified vehicles that match your level of skill and your psychological makeup. This is not defeat. This is wisdom. The second element is to control what you can control. You cannot control the market. You cannot control the economy. You cannot control what other investors do or what events will shake the financial world in the coming months and years. What you can control is how much you pay in fees and taxes. What you can control is how much you save. What you can control is how long you stay invested. What you can control is your reaction to market volatility. Focusing your energy on these controllable factors, rather than on trying to predict the uncontrollable ones, is one of the most important things any investor can do. The third element is to think long-term and mean it. Not just in the sense of saying the words, everyone says the words, but in the sense of actually structuring your investing behavior around long-time horizons. This means resisting the temptation to check your portfolio every day. It means resisting the temptation to act on every piece of news or every market movement. It means having the discipline to hold good investments through periods of short-term decline, knowing that the long-term fundamentals remain intact. It means being willing to look wrong in the short term in exchange for being right in the long term. The fourth element is to maintain a margin of safety in everything you do. Do not invest more than you can genuinely afford to lose. Do not take on debt to invest. Do not concentrate so heavily in a single idea that a bad outcome could be catastrophic. Always keep some reserve. Always maintain the ability to survive the worst reasonable outcome and come back to fight another day. The investors who have built the most durable long-term records are not the ones who made the most money in the best times. They are the ones who survived the worst times without being permanently impaired. The fifth element is to keep learning. Always. Relentlessly. The world changes. Markets evolve. New industries emerge and old ones decline. New ways of creating value appear that require new frameworks for understanding them. The investor who stops learning, who becomes satisfied with what they already know, who stops testing their assumptions against new evidence, is the investor who is quietly becoming obsolete while congratulating themselves on their past success. The great investors in this book, even those who are very old, are all still voracious learners. They read constantly. They talk to interesting people. They visit companies and industries. They challenge their own assumptions regularly and genuinely. They remain, at the core of their being, curious. And that curiosity, that open-minded engagement with new ideas and new evidence, is one of the most powerful competitive advantages available to any investor. The sixth element, and perhaps the most important, is to take care of your inner life. The outer world of markets and economies and business cycles will always be uncertain and unpredictable. The one thing you can influence is your own state of mind. Investors who are anxious, reactive, emotionally volatile, or whose self-worth is tightly tied to the performance of their portfolio will make worse decisions than investors who are calm, patient, self-aware, and emotionally grounded. Building that inner stability is not something that happens automatically. It requires deliberate work. It requires the kind of self-knowledge and self-management that comes from genuine reflection, honest self-assessment, and the development of perspective about what truly matters in life beyond the daily fluctuations of financial markets. William Green, having spent years talking to the greatest investors in the world, came away with a conclusion that is both humbling and inspiring. He concluded that the most important qualities for success in investing are not the ones most people spend their time developing. They are not complex analytical skills, or deep knowledge of accounting, or mastery of complex mathematical models. The most important qualities are the quiet, slow-growing, inner qualities of wisdom, patience, intellectual honesty, emotional discipline, and the kind of genuine long-term perspective that comes from having thought carefully and deeply about what really matters in life. These qualities are available to anyone who is willing to work for them. They are not the exclusive property of geniuses, or the wealthy, or the well-connected. They are the product of deliberate practice, honest reflection, and the willingness to keep learning and keep growing throughout an entire lifetime. And the reward for developing them is not just financial, though the financial rewards, for those who develop them, genuinely can be extraordinary. The reward is a richer life in every sense of the word, a life characterized by greater wisdom, greater clarity, greater calm, and greater genuine happiness. It is worth pausing for a moment to consider what we mean when we use the word richer. William Green's title, Richer, Wiser, Happier, is carefully chosen. These three words are placed in a specific order, and that order is meaningful. You become richer first. Then, through the process of learning how to become richer, you become wiser. And then, as a consequence of becoming wiser, you become happier. The path from money to happiness runs through wisdom. Without wisdom, money tends not to produce happiness in any reliable or lasting way. With wisdom, it can be a powerful tool for building a life of genuine richness and genuine joy. What does the journey from money to wisdom to happiness actually look like in practice? It looks like Howard Marks spending decades refining his understanding of cycles and risk until he can navigate even the most extreme market conditions with a kind of philosophical serenity that very few people in the investment world can match. It looks like Charlie Munger, at nearly 100 years old, still reading, still thinking, still engaging with new ideas, with the curiosity and enthusiasm of a young man who has just discovered the joy of ideas. It looks like Mohnish Pabrai building a foundation that has changed the lives of thousands of young people, finding in that work a depth of satisfaction that no investment return could ever fully provide. It looks like John Templeton living and working from his island home in the Bahamas, surrounded by beauty and simplicity, giving away his wealth as fast as he could make it, and dying as one of the most genuinely content people who ever worked in finance. The world of investing has a way of attracting a particular kind of person: competitive, driven, ambitious, focused on results. These are not bad qualities. They are the qualities that produce extraordinary achievements. But they also come with characteristic dangers. The danger of becoming so focused on results that you lose sight of why the results matter. The danger of becoming so competitive that you confuse beating others with being genuinely successful. The danger of becoming so driven that you cannot slow down enough to enjoy what your efforts have produced. The great investors in this book had all of these qualities: the ambition and the drive, and the competitive fire. But they had also developed, through experience and reflection, a deeper perspective that allowed them to see their investing work in the context of a whole human life. And that perspective, that broader, deeper view, is what made them not just excellent investors, but genuinely admirable people. Let us spend a moment on something that William Green discusses toward the end of the book: the concept of inner scorecard versus outer scorecard. Warren Buffett introduced this concept many years ago, and it has become one of the most quietly influential ideas in the investment world. An outer scorecard measures your success by how you compare to others. How much money do you make relative to your peers? What is your ranking in the list of performance tables? What do other people think of your results? What is your reputation in the investment community? An inner scorecard measures your success by standards you have set for yourself based on your own values and principles. Did you act with integrity? Did you follow your own well-considered principles? Did you make decisions that you would be comfortable defending to yourself, regardless of whether they look good in the short term to others? The great investors all operate primarily on an inner scorecard. They care about their reputations, certainly. They want their clients to be satisfied. But they do not make decisions based on what will look best in the short term to outside observers. They make decisions based on what they genuinely believe is right, based on their own careful analysis and their own deeply considered principles. This inner orientation is what allows them to hold unpopular positions, to look wrong in the short term while being right in the long term, to resist the enormous social pressure of consensus. And it is what allows them to maintain their integrity, even in an industry that sometimes creates powerful incentives to compromise it. The inner scorecard is not just an investment concept, it is a life concept. How many of the choices people make about their careers, their lifestyles, their consumption, their relationships, are made in response to an outer scorecard, to what other people will think, to how they will compare to their peers, to what society tells them success looks like. And how different might those choices be if they were made primarily in response to an inner scorecard, to what the person themselves deeply values and believes, to what kind of life they actually want to live, rather than the kind of life they want to appear to live. This distinction between genuine success and the appearance of success is something that the wealthiest and wisest people in the book have resolved clearly in their own lives. They are not interested in appearing successful. They are interested in being successful, in the deep sense of building a life that is genuinely meaningful, genuinely satisfying, and genuinely in alignment with their own deepest values. And because they are not spending enormous energy and resources maintaining a performance of success, they have far more of those resources available to actually build something real and lasting. There is something remarkably liberating about this perspective when you truly internalize it. When you stop measuring yourself primarily against others and start measuring yourself against your own genuinely held values and principles, a whole category of anxiety simply evaporates. You stop worrying about what your neighbor is making in the market. You stop feeling inadequate when someone else's portfolio performs better than yours in a particular quarter. You stop making decisions based on fear of what others will think if you are wrong. You start making decisions based on your own careful assessment of what is true and what is right, and what is likely to produce genuinely good long-term outcomes. And this shift in orientation, from external to internal, from comparative to absolute, from appearance to reality, is one of the most powerful gifts that the study of the greatest investors can give you. One more deeply important theme deserves careful attention: the role of simplicity in extraordinary investing results. Most people in finance assume that sophistication is a virtue. They assume that more complex models, more data, more variables, more layers of analysis produce better outcomes. The evidence from the investors in this book strongly suggests the opposite. The most durable and most extraordinary investment results over long periods of time have been produced by people with simple, clear, well-defined principles, applied consistently with great discipline over many decades. Charlie Munger does not use complex computer models. He uses mental models from many disciplines, applied in a common-sense way to specific situations. Howard Marks does not try to predict the market mathematically. He reads the environment carefully, understands where he is in the cycle, and calibrates his risk-taking accordingly. Nick Sleep did not diversify across hundreds of stocks with complex risk algorithms. He found two businesses he believed in deeply and held them for many years. Tom Gaynor has 4 criteria, applied consistently to every potential investment. Francis Cho looks for cheap things and waits for the market to recognize their value. The simplicity of these approaches is not accidental. It is the result of years of refinement, of stripping away everything that was complicated, but not actually useful, everything that added sophistication without adding insight. Real clarity, the kind that allows you to act decisively and hold your convictions under pressure, requires simplicity. When your investment principles are simple, clear, and deeply held, you can explain them to yourself in a moment of doubt or fear, and that explanation can be enough to hold you in place when your instincts are screaming at you to flee. When your investment principles are complex and multi-layered, no amount of explanation will save you in the moment of maximum emotional pressure. Complexity collapses under stress. Simplicity holds. This is true in life as well as in investing. The people who navigate difficult situations with the most grace and effectiveness are usually the people who have done the hard work of figuring out what they truly value and what they truly believe, and then distilled those values and beliefs into a small number of clear, actionable principles. When a crisis hits, they do not need to figure out what to do. They already know. Their principles tell them. And because their principles are clear and simple, they can access them even in the fog of crisis, even when fear and confusion are working hardest to scramble their thinking. As William Greene's extraordinary journey through the minds of the greatest investors comes to its conclusion, he arrives at a simple but profound synthesis. The richer, wiser, happier formula is not a sequence of separate achievements, but an integrated whole. The process of becoming genuinely richer, in the deepest sense, which includes not just financial wealth, but the full range of resources that support a good life, is also the process of becoming wiser. And the process of becoming genuinely wiser, which means developing a more accurate, more humble, more disciplined way of understanding and engaging with the world, tends to produce genuine happiness as a natural consequence. This is not a guarantee. Nothing in life is. There are people who are genuinely wise and genuinely poor. There are people who are genuinely wealthy and genuinely unhappy. Life is complex, and no simple formula captures all of its complexity. But as a general orientation, as a guiding principle for how to approach the great questions of how to manage money, how to think clearly, and how to live well, the insight at the heart of this book is as valuable as anything you will find in the entire literature of personal finance and investing. The insight is this: invest in your own wisdom, not just your financial knowledge, though that matters, not just your analytical skills, though those matter too. Invest in the deepest, most fundamental qualities of mind and character that allow you to navigate uncertainty with grace, to make decisions with integrity, to hold your convictions with discipline, and to build a life that is genuinely rich in every dimension that matters. These are the qualities that the greatest investors in the world have spent their lives developing. These are the qualities that have made them not just successful, but admirable. And these are the qualities that are available to any human being who is willing to do the patient, difficult, deeply rewarding work of cultivating them. You do not have to be a professional investor to benefit from this wisdom. You do not have to manage a fund or analyze balance sheets or follow the market every day. You simply have to be willing to think more carefully, to act more deliberately, to learn more continuously, and to hold yourself to a standard of integrity and wisdom that most people, rushing through their busy and distracted lives, never quite manage to reach. And if you can do that, if you can bring even a fraction of the discipline and the wisdom and the patient intelligence that the greatest investors have brought to the management of money, to the management of your own life, then you will find yourself, gradually but unmistakably, becoming richer, wiser, and happier in ways that no market crash and no economic crisis can ever take from you. That is the gift of this extraordinary journey through the minds of the greatest investors of our time. Not a formula for getting rich, not a system for beating the market, but a vision of what it looks like to engage with the complexity and uncertainty of the world with genuine intelligence, genuine courage, and genuine wisdom, and a deep, abiding conviction that such engagement, sustained over a lifetime, is the foundation of everything that is truly worth having. The journey through these extraordinary minds has been long, and it has been rich. From Charlie Munger's lattice work of mental models to Howard Marks's deep understanding of cycles. From John Templeton's extraordinary willingness to invest at the point of maximum fear to Nick Sleep's concentrated faith in businesses that truly serve their customers. From Mohnish Pabrai's disciplined cloning of the best ideas to Tom Gaynor's patient search for quality at a fair price. From Ed Thorp's mathematical clarity about risk to Jean-Marie Eveillard's unwavering commitment to the preservation of capital. From Joel Greenblatt's elegant simplicity to Francis Cho's patient virtue. Each of these people has something different to teach. Each has their own style, their own emphasis, their own particular genius. But they all share something fundamental. They all share an orientation toward reality that is honest, humble, disciplined, and long-term. They all share a willingness to do the hard inner work of understanding their own psychology and building systems to protect themselves from their own worst instincts. They all share a commitment to continuous learning and improvement throughout their entire lives. And they all share, in one form or another, the insight that money and wisdom and happiness are not separate pursuits, but deeply interconnected aspects of a single, well-lived life. This is the message to carry forward from this journey. Not a stock tip, not a market prediction, not a trading strategy, but a set of principles for thinking more clearly, acting more wisely, and building a life that is genuinely rich in all the ways that matter. The road is long. The work is hard. The rewards are real. And they are available to anyone who is willing to pay attention, think carefully, act with integrity, and stay the course through all the uncertainty and volatility that life and markets will inevitably bring. Stay curious, stay humble, stay patient, think for yourself, manage your own psychology with as much care as you manage your portfolio. Give as much as you take. Build something that lasts. And always, always remember that the ultimate purpose of building wealth is not the wealth itself, but the freedom, the security, the generosity, and the genuine human flourishing that wealth, wisely built and wisely used, can support. That is the lesson of the richer, wiser, happier formula. And it is a lesson worth a lifetime of study, a lifetime of practice, and a lifetime of genuine, humble, grateful attention.